Okay. Now let's understand about factoring with recourse example. When I say with recourse, it means the company who is selling their debtors, they guarantee that they will be paying final amount. If the debtors don't pay, then the company will pay that amount. So let's take the scenario of Best Buy company who sells $300,000 of accounts receivable to a factoring company with recourse. Now the factoring company charges $10,000 for fees for the services, and Best Buy guarantees payment for any receivable that become uncollectible. So out of this $300,000, if any amount is not paid by the accounts receivable, then this Best Buy will pay them off. Basically, they are giving the guarantee against them. Now, the key point in practice is simple, that transferor can estimate obligations for uncollectible. Basically, this Best Buy estimates that how much uncollectible may be there. So, the Best Buy estimate potential uncollectible receivables at $5,000. So, out of this $300,000, $5,000 may be uncollectible. That is the estimation by the company. Transferor surrenders control of future economic benefits. Now, what happens? The transferor, like the Best Buy, won't receive the accounts receivable or the money in their bank account, because what will happen, the factor now collects the customer payment. Factor will be going and collecting the customer payment. It belongs to factor now. The transferor cannot be required to repurchase but may replace receivables. It simply means that if any receivables are uncollectible, that some become bad, Best Buy will pay to the factor. At the end, conclusively, the factor company will get its entire money from the Best Buy or the debtors. If debtors don't pay, then the Best Buy will pay. So the accounting implications will be like this. Since all conditions for the sale are met, the transaction is treated as a sale value, because this is the condition for sale. When we read about revenue recognition, within that chapter, the conditions for sale were like the control is being transferred, economic benefits are being transferred. So if this is treated as a transfer, then this is a sale because all those conditions are being done. Now, if any conditions not met, the transfer would instead be treated as a loan with the receivable as a collateral. So basically, the conditions of sales is like the factor will be receiving all the money, the risk belongs to factor, everything, not the risk, I can say economic benefits will belong to factor. So this is just like treated as a sale, and if these conditions are not met, then this will be treated just like a loan with the collateral. Now key takeaways from it is, what with recourse factoring, transferor risk back to the seller for uncollectible amount. This is what we know, that the risk, if the seller, or not the seller, the accounts receivable or the debtors don't pay on time or complete payment, then the company Best Buy is responsible for that. It is common in industries where receivables carry some uncertainty. So this is common in certain industries because people need the money immediately. Now let's see the example, not the example, but the same concept through the textbook what we read above. So a recourse, or I can say with recourse sale, means the factor can require the seller to repurchase or replace uncollectible receivables. Now its accounting treatment will be like, when receivables are transferred with recourse, the transaction can be treated as a sale. We can treat it like a sell, just like we read it, if the conditions of sale are met. If the conditions of sale are not met, then this is treated as a borrowing, wherein receivables are treated as a collateral. Okay. Now what are the conditions for sale? This we have studied in revenue recognition as well, but these are the conditions of sale, wherein we have read that the seller's obligation for uncollectible accounts can be reasonably estimate. We can estimate the bad debts, how much they will be. Then seller surrenders the control of future economic benefits. All the future economic benefits belongs to the factor. And lastly, the seller cannot be required to repurchase the receivables, but may be required to replace them with similar receivables, which is like let's suppose on January 30th, the seller is having receivables worth $200,000. Then out of those, let's suppose $30,000 have paid receivables. Now they are having balance receivable of $170,000 in February. But also in February they have sold some new credit sale, and that new credit sale is worth against 30,000 now. So you will say at the end of the February, again the company is having $200,000 worth of new credit sale. So the total language here is like the seller cannot be required to repurchase. Seller won't be repurchasing it, meaning the best buy company in our case won't be repurchasing it, but may be required to replace them with similar receivable. So earlier there were $200,000 of receivable, then 30,000 paid, and then 30,000 new receivable created. So we have replaced these old receivable with these new receivables of 30,000. So this may be one of the case as well. Now finally, if the transfer is treated as loan, not a sale, with the receivable as a collateral. So if the conditions are not met, if as we studied above for the sale, then this will be treated as a loan and this won't be treated as a collateral.